The following is paid programming.
Something More with Chris Boyd, certified financial planner professional.
I could work my life away, but why? I got things to do before I die. There's gotta be something more. Gotta be more than this. I need a little less harm.
Now, your fulfillment facilitator.
Help me help you. Help me help you. Help me help you.
Your partner in prosperity.
Show me the money! Derek, you better yell! Show me the money!
Advising clients across the country. Here he is, your host, J. Christopher Boyd.
Happy New Year. Welcome to Something More with Chris Boyd. That's New Year's in Dubai, anyway. New Year's Eve. Hard to believe we are wrapping up 2022, and the last day of the year, we've got our show. Thanks for being with us. Our show is a financial show. We call it Something More because we like to talk about not only those important dollar and cents issues, but also the quality of life issues that make the money matters matter. I'm Chris Boyd, certified financial planner practitioner, and my firm is Asset Management Resources. We are a registered investment advisor firm. We work primarily with people in retirement or near retirement, but happy to work with anyone who might need our services in financial planning or portfolio management. Thanks for being with us. On our show today, lots to talk about. We were expecting to be on last week, but got a call kind of late in the game saying, don't forget, the Patriots are going to be on, and you're bumped from the show this week. So we didn't get a chance to wish everyone a happy holidays, a Merry Christmas, which we would have otherwise done. So I'll mention it now. Merry Christmas to everybody, and thanks for tuning in for our show today. We have lots to discuss. Coming up this hour, I'm going to be speaking with Brian Regan in the next segment or two, and we'll do a little bit of review. What were some of the major drivers of what happened in the market this year, and some perspective about what's to come. In the second hour, we're going to be talking with Scott Birmingham, our firm's lead financial planner. Got a variety of things we're going to talk about with him, including some perspective on the Secure 2.0, the latest legislation that came out from the Congress over the last couple of weeks, and has some very direct impact on some of the planning that you may do. And in addition, we'll be talking with people from the Needy Fund. This time of year is one where the Needy Fund does so much great work. So I'll give you one more reminder about a great charity in our midst doing some great work for people in need. All right, well, that's our intro. Lots to talk about. Let me start off. This week, I want to make sure we start off telling you about our offer. But before we do that, I thought, I came across an article. This has been a tough year. There's just no getting around it. If you're an investor, it's definitely been unsettling. We've had big moves by the Federal Reserve and, of course, catalysts like the war in Ukraine and all kinds of things that have been disruptive to the stock markets. And so I thought maybe just to soothe your sentiments, it might be helpful to get a sense of what happens after a big disruption in the market. What typically happens. And so I came across an article that it was written earlier in the year, but I thought it still had lots of good content that we might make some use of for you today. And it talked about the fact that stock market losses occur for various reasons, whether it's, disruptions with valuations, excessive valuations like the tech bubble in 2000, or We've had, economic disruptions in other periods. And this year, you look at the war and the global pandemic still having some consequence in maybe not so much directly it's in terms of the pandemic, but in terms of the aftermath of that's still affecting our economy and market circumstances. So I thought it'd be worth sharing some of these tidbits that were in this article that I came across. Just as an aside, it was called "How Has the Market Performed After Its Worst Years?" and it is by CD Wealth Management. One of the details was that markets have experienced 2 consecutive negative returns only 8 times since 1928. And it has experienced 3 of those consecutive years, 3 consecutive years of negative returns 3 times in the same period. However, this only happened during once since the Great Depression. So most of that happened during the Great Depression. The long-term returns following the worst performing markets have been strong. The average 3-year returns is 35%, while the average 5-year returns is over 80%. The results for the years following the worst performing years are mixed, however. There has only been one 3-year period with negative returns, which was during the Great Depression. Since 1929, there has been 26 bear markets, this article says, 15 of which were tied to a recession. The average length of a bear market in the S&P 500 index has been 9.5 months. For bear markets which have been tied to a recession, the average decline was 35%, and those without recession, the average loss was 25%. It remains to be seen whether we're going to be tied to a recession, but I think the odds are likely that that's the case. There is a chart that First Trust puts out that they referenced in this article, and it looks at markets, bull and bear markets since 1942. And during that time, the average cumulative return of a bull market has been 155%, while the average bear market loss is more like 32%. It's important to note that the length of time of a bull market compares to a bear market. The bull market has lasted on average about 4.5 years, 4.4 years, they say on this article, while the bear market has lasted on average 11 months. Well, I don't know if that's helpful data for you to get a perspective on this, but my point to try to share this with you is to point out, one, that markets more often go up than they go down. And in times when they go down, it's unsettling, and you can't help but think, am I doing the right thing? Do I have the right investment mix? Do I have enough time to have it make it back up? How long will it take before I get back to where my high water mark? And it can take very commonly 3-5 years for that to happen. That's not likely, what we're going to expect this time. But I'll give you a sense. This was from J.P. Morgan. Let's see if I can find this promptly while I'm talking with you. There was an item from J.P. Morgan the other day that I saw where they were looking at, given the declines that we've had from, the trough, which we went down on the stock market, S&P 500, about 25% from the peak to the trough. And as of a couple of days ago, the 22nd, they were saying that, we need to make up about 27.3% to get back to the peak. And if we didn't get that in a single year, that'd be in 1 year. We need to get that kind of a bump. But, maybe what would it take in 2 or 3 years? Well, in, let's say, a 3-year, we just need an average of 9.7% to recover and get back to and maybe start moving ahead of where we were. So, and if you think longer term, it would only take 6.5% per year for 5 years. I think what's more likely is that we're not likely to take 5 years to recover, but it does take time to recover when you have setbacks. But the good news is, when you look at what's happening in the economy right now, when you look at what's happening, inflation is starting to taper, which is good news. The interest rates are high, and that's going to have a slowing effect on the economy. But will it affect earnings of corporate earnings overall? Well, we're going to talk a little bit more about that in the next segment, I'm sure. But I think that's the big question. How will corporate earnings be affected? And if earnings continue to be relatively strong, as they have continued to hold up this year, that's very encouraging for what will happen with prices of stocks over time. So, fundamentally, this comes down to, how should I be positioned? What are the risks I'm willing to take? What are my cash flow needs over time? If I've got plenty of time, that's one thing. If I'm close to retirement, it may be a very different thing. So this time of year is a time of year when people really give thought to their portfolio. We often offer this at the beginning of the year, and we are again this year as we have this transition from 2022 to 2023. We're offering a complimentary portfolio review, and this complimentary process is quite substantive. It is free of charge. It is a complimentary offer. You're welcome to come, kick the tires, hear what we have to say, and maybe you decide it's not for you. We're going to basically take the advice, don't take the advice. It's up to you. Okay, it's a complimentary offer. What we're going to do is have a 2-meeting process. We gather your details. We'll send you out either a kit or an email and give you some means of gathering the pertinent information. We want to get to know you financially in this first meeting. And in the process, we really want to get to know what's on your mind. What's your worry? What's your concern? What's working? What's not working in your view? And we'll gather all that information, meaning your statements, your investments, what kind of cash you're sitting on, whether it's enough or not. We'll look at your expenses, your income, assets and liabilities, okay, and any other relevant material that is, thinking about your particular situation. We gather that and talk to you a little bit, get to know your situation. Then we go back and do some assessment, review things, look at it for what's working, what's not working, what may be issues. We evaluate how would we advise you. And we put together a PowerPoint presentation. We examine the forecasting of your financial plan, and we come back to you with a presentation. And in this presentation, we identify for you some observations, some recommendations, things you might want to consider. And in the process of doing that, of course, we'll share with you how we work with people. And if you have an interest, we'll invite you to feel free to come back. But again, we offer this as a complimentary service. We are a fiduciary. We're not selling product. And so it's our interest and intent to try to help you. And if you're a good fit for us, to be aware that we could be a resource for you if you should want to work with someone like our firm. So it's, I think, a great opportunity. We're trying to, provide a lot of information, a lot of resources for you on a complimentary basis, because this is the time of year when people are most concerned and attentive to their financial planning and portfolio management. We'll look at all of the holdings you own. We'll look at how they all work together. We'll look at where they're placed in your portfolio. People oftentimes have concentrations in different types of investments or, maybe specific investments. Maybe they have a lot of the same kinds of things. They may have just too much of one, maybe it's too much stock, not enough stock, whatever it might be. We will look at your situation, look at how your portfolio is structured, and give you some very concrete observations and recommendations. So I hope you'll take advantage of this offer. We've done this in the past, and we don't do it, for a long time. It's a limited offer. You will hear about it on our advertising on the radio show and on WXDK. So we hope you'll take advantage of it. We got a lot more to talk about on the show, but take advantage of this right now. Let me just tell you how to do that. You can reach out to us through our website, amrfinancial.com. You can give us a call. Again, that address is amrfinancial.com. You can also send us an email if it's easier at radio@amrfinancial.com. Just include the offer in your subject and how to reach out to you. We'll be in touch. You can connect with us by phone, 508-771-8900. If you prefer, toll-free, 866-771-8901. And you can text us if that's easier for you. Send us a text at 508-915-3700. Those are all the ways you can take advantage of this. Or reach out to us. Make sure you mention the offer, and we'll follow up with you with a kit for preparation for our first meeting, and we'll schedule a time to get together. Do it early, because the longer we do this offer, the more people will get in front of the line, and you'll want to do it sooner rather than later. All right, thanks. We're going to take a break. We'll be right back after this. Stay with us. Next up, we've got Brian Regan joining us, our firm's Chief Investment Officer. Brian, Happy New Year's Eve, first off.
Happy New Year's Eve to you too, Chris.
Thanks. Hard to believe it's been just a very volatile year. I thought maybe we could take a few minutes, talk a little bit about what happened over the course of the year and what were some of the drivers and how that might be changing as we look ahead to a new year. I think it's challenging for investors. This is a time of year when oftentimes people do spend a little more time thinking about their accounts. I'm sure as people get their year-end numbers, for people who only look at it periodically, it'll be a disappointment. It's been a rough year. So let's start off with what happened this year that were drivers of market movements.
Well, I mean, that's a really loaded question, as you know, Chris. But I think, looking back, off the cuff here and thinking about what were the major things, I think we entered the year probably a little high on valuation. I think when we did our beginning of the year webinar, we talked about reassessing your risk assessment.
Yeah. You think in the context to go dive into that, Brian, I mean, the market had gone up, stock market, nearly 30%, 28% or something. It was like a 3 years worth of returns happened in a single year last year. So it did feel a little bit extended when you started off the year, right?
It was extended based on where interest rates were and where interest rates were likely headed. I mean, I think we could make the valid assumption at the time that interest rates were probably heading higher from zero, where they were. But we did, I think, to anybody who said that they expected them to go this high,
probably not, right? Yeah.
Yeah, I don't think that was, very much expected. But, to your point, in 2021, the market was, the stock S&P 500 was up nearly 30%, almost 29%. Which was a phenomenal year, obviously, right? And it wasn't just, feel. I think objectively it was a little overvalued. I think we estimated relatively meager returns. I remember I didn't necessarily want to predict a negative return because that so rarely happens. But I do think the lower bound of our estimate was negative 1% for the year. Obviously, we were off by a sizable amount.
Went down significantly more.
But even at the beginning, I don't think we were necessarily expecting a fantastic a fantastic year, or anywhere on par with what we saw in 2019, 2020, and 2021. 2019 it was up 31%, 2020 up 18%, 2021 up almost 29%. Those are phenomenal years, and even with the year that we've had now, over the last 10 years, the stock market has done on average 12.5%. So yeah, I mean, we just went through a bear market, and the stock market over the last decade has still outperformed the long-term average. So we came out of a period that was phenomenal, and we had what started looking like a correction turn into a bear market, and I think that's a general summary of what happened this year.
Yeah, I mean, I think you want to talk about the Federal Reserve in this conversation. You mentioned interest rates, and we had everyone has been feeling the effects of inflation as a concern this year. You can't help but notice, whether it's with your gas pump, with your grocery store, whether it's prices in all kinds of ways, going out to dinner. You're feeling some of these effects, right? And so the Fed's made an effort to try to tackle that issue and mitigate it, try to stop it from rising so fast. And the only way they can do that really is to try to slow the economy so that rates don't rise as fast when in an environment when the economy slows down. So in any case, so the inflation rate, I mean. So as a way to do that, the Federal Reserve raised interest rates. How much did we do from start to finish this year, Brian, on the short-term
we
Fed
were
fund
at
rate?
Effectively zero to start the year, and now we're at 4.5%. So
pretty substantial.
Quarter to 4.5%. Really,
is the the Volcker era, back in the early 1980s, is that the only time we've had, at least in modern era, this kind of dramatic jump? You'd have to go back to the Great Depression or something beyond that.
I don't think we've ever had a single year with this big of a jump.
So it's dramatic in that experience.
Don't quote me on that, but I think that's true.
So to give context, that kind of thing, it's a dramatic, unusual, extreme change in policy when it came to monetary policy. And naturally, that's had some consequence on investors. To your point, stocks are relative to what else investors can do. And when there was a zero interest rate environment, people were willing to pay more for stocks. When there's a higher interest rate environment and alternatives that can look more attractive, well, maybe they're not willing to pay quite as much. So valuations have come down. So then how does this affect, what's happened in bonds comparatively?
Well, bonds have easily the worst. I think the worst year since 1788.
Is that right?
Yeah, I think it's the worst year since 1788, which the country was only 12 years old at the time. But this is an interesting. It's been an interesting year for sure, and I think we'd be remiss if we are going to recount the year and ignore the Russian-Ukraine war.
It's a good point.
Which, really threw a monkey wrench into what was already kind of a tough outlook.
Yeah, it's a good point. What are the ways in which that the conflict, Russia's invasion of Ukraine, how has that had a consequence on the economy and the markets?
Well, it most notably had an influence over food and energy prices. We might be hard to remember at this point, but we had gas prices near $5 a gallon. On the national average, maybe even higher than that in some places. I know I saw north of 6 when I was in California at one point. Now, I think the national average is below $3. But there was certainly a dramatic spike as the anticipation of all those barrels of oil won't be flowing to the West anymore. I think in a variety of ways, the capitalism caught up with that issue and has solved it to a certain extent. Not completely, obviously, where Europe is still certainly under an energy crunch, most notably with the natural gas situation. But that obviously raised inflation to eye-popping levels. We were having month-over-month inflation that was very high. I mean, almost 2%. So that's lately I've been annualizing my inflation numbers. So if you're 1.5%, 2%, your annualized rate is close to 20%. That's some crazy numbers, right? Where today, we arguably have deflation if you annualize the numbers. So, from the inflation perspective, we had just some wild changes. So I'll give you those on the PCE number. At the beginning of the year, we had numbers as high as 1%. So that's 12%, and the CPI was higher. I'll look up the CPI while we're talking here and maybe give you an interesting number there. The CPI got as high as month-over-month number of 0.8, so it was actually lower. But we were on a run rate of 12% there at the beginning of the year following the invasion of the war, and those numbers have settled down to negative to below 2%. Kind of where you would want them to be on a long-term basis. What the Fed's saying to us, but.
So it remains to be seen if that'll stay the core, if it'll stay those lower levels, and then, we're at a point where inflation seems to have been handled, at least, let's say.
But when you have a whiplash inflation like that, right? And I don't know any other better word.
Yeah.
But we essentially went from 12% at the highs post the invasion to let's call it 0 to 1% today. Well, what you're going to have is you're going to have interest rates fly up, which they did all across the curve. And now we have this crazy inversion, right, where the longer end is much lower than the higher end because the market is saying that, inflation's kicked and the Fed's saying we want to make sure it's kicked. And that has caused some wild volatility in both the bond and the stock market. And you made mention earlier about how, the bond market has an effect on the stock market because of, competition, right? It's a lower risk asset, and if you're getting paid more on it, valuations on the stock market need to come down to make up for that fact. And that happened, and it's happened violently as we're seeing these violent changes in bonds. We're also going to see violent changes in stocks, and we've had multiple days this year that were around 4%, 4% days, which I think there's only been a couple handful of those in history. And, there's certainly been a few this year.
Well, let's pause there for a moment. Let's come back and talk a little bit about what might be 2023 looking like. What are some things we might expect? So stay with us. We'll be right back and hopefully give you some insights for thinking about how to be positioned going into a new year. We'll be right back. Stay with us. Welcome back to Something More with Chris Boyd. I'm talking with Brian Regan. He's our firm's chief investment officer, and we're talking a little bit about a little retrospective. It's been, a very volatile year, some extreme occurrences, whether it's the movement in interest rates or certainly we've been feeling it when it comes to our portfolios, all of us, everyone who's invested. When it comes to inflation, it's been on everybody's mind and a driver for why monetary policy has moved as it has. So let's step back and take a thought as we kind of look forward to a new year. It's hard to, no one can predict, of course, Brian, so not looking for you to say, oh, this is how you should expect and where you should be. But what are some things we might anticipate as we look ahead? I think we want to make the distinction between economies and markets. I think we might want to think about, are there opportunities? What are some of the things that, based on where we've been, does that present some possibilities? So there might be different things on your mind. Where should we begin?
Well, let's talk about the economy first, and then maybe we can think about how that could spill out into markets and maybe what it means for your money and Normally we would do something like this during a webinar. So everything I'm about to say, I'd say is a half-baked idea.
And we will actually be providing a thoughtful, data-oriented presentation to our clients in the coming weeks. So I'm sure we'll have a chance to talk and share some of that on the show as well. But yeah, just let's kind of get some big picture thinking.
Okay, so I think inflation is going to come down dramatically. I think starting with the it already has come down dramatically.
Yeah, seeing it.
We talked about in the prior segment how it was 12% on an annualized run rate following the invasion of the war, and now it's a run rate 0 to 1% depending on how you look at it. The highest estimate I can get to today is about 2.4%. On a 3-month annualized basis, it's dropped about half from the June high. So we've seen inflation fall dramatically. I think that's going to continue to happen in 2023. If you're out there and you're listening and you're saying inflation's at 7.1%, you don't know what you're talking about. Those are year-over-year numbers, and I'm talking about annualized month-over-month numbers. So we might just be thinking apples and oranges, but I can almost picture people's.
You're taking a monthly figure and trying to extrapolate what that means for an annualized rate, which is different from when you're accumulating all these monthly figures over a year.
Yeah, so that's 7.1% CPI number. That's backward looking, and I'm trying to be more forward looking as the numbers are changing very, very quickly. So we know that we had a dramatic change in inflation in February and March and April through June, really, following the invasion of Ukraine. So if we're looking at year-over-year numbers, mathematically, assuming things kind of stay in the status quo where they are today, we should expect a dramatic drop just as those months lap. So basically, those numbers we're printing 1% month-over-month numbers. As we start printing 0.1, 0.2% in those months, you're going to see a dramatic decline in that year-over-year figure.
Yeah.
So mathematically, just on a measurement basis, it's likely to come down pretty dramatically in the first quarter of 2023. Secondly, that's the mathematical measurement fact that inflation is likely to come down. There's also the fact that the economy is likely going to slow. So the Federal Reserve has been raising interest rates at an unprecedented rate, as we talked about in the last segment. The effect of those interest rates on the economy take time to filter in. We haven't fully seen the effect. So given that assumption, it's probable that the economy is going to slow rather significantly in 2023. That means that inflation will come down even further. Now, we've seen this already happen in durable goods, the durable goods sector, most notably in used cars, which is actually being deflationary right now on a month-over-month basis, in new cars, which is flat and trending to be negative in future months. What the Federal Reserve wants to see is the labor market soften. So they've been very, very blunt about this. And I think it's very, very, very difficult to weaken the job market, which essentially means, they want to see unemployed people, they want to see layoffs, without causing a recession. So I think a recession is also likely.
So a recession, we're thinking,
we're
thinking it's very plausible, almost likely that we're going to see a reduction in inflation. We're going to see a recession in next year. That means jobs will be, more difficult to come by, or at least affected. But in this, the jobs data will be affected, and maybe less. There's been a lot of upward pressure on wages this year. Less of that kind of a concern. So all this seems to be slowing economy kind of data. What does that mean for an investor, or was there more you wanted to comment about that?
I just wanted to sum up that a recession is likely. It's not guaranteed, but it's likely. Inflation falling, also very, very likely. It's more about how much it's going to fall. Is it going to make that 2% mark at the end of 2023, or is it going to be more elevated? The 3.5%.
Yeah.
but it's going to fall dramatically from the 7.1% number. So, I don't think discretionary spending won't be as available, which is going to hurt things, further. Now, I guess the question is, how deep and how long is this recession going to last? I would say that the bulk of the evidence says that it's not going to last for very long, and I obviously hope I'm right on that. But it's tough for people to wrap their minds around that, because the two, disregarding the pandemic, the last two recessions that we had were the Great Financial Crisis and the dot-com bust, and both were fairly long recessions. One, it didn't help that we had 9/11 just as we were climbing out of the recession, so it was kind of a double-barreled boom there in 2001.
Right.
But the Great Financial Crisis happened because there was a credit crisis. We don't have any signs of a credit crisis right now. Is it possible that it could develop from, some mistake in the economy? I'm looking at you, cryptocurrency. Yes, it's possible. Is it possible that, there could be a geopolitical event that could make things worse? Absolutely. But the reality is, the reason why we don't have a credit issue is because from a personal balance sheet perspective, people are very well off right now comparatively. There's a lot of equity in their homes, so even if home values fall significantly, they likely won't be underwater. Adjustable rate mortgages aren't a thing, as they still exist, but they're not as prominent as they were during the subprime crisis and the Great Financial Crisis. Banks are much more capitalized. They are stress tested regularly. It's generally agreed upon by all market participants that the banks are relatively healthy. Now, I heard that tune before, so it's something that you need to continue to monitor. But given those facts, it's hard to believe that we will have, a credit crisis of sorts. Company balance sheets, I don't think I mentioned that, are very solid as well, relatively speaking. So yeah, I think it would be a relatively short recession. Now, what would happen during the recession? Well, the Fed will stop being so aggressive, right?
Yeah, that's exactly where I wanted to go. Yeah. Okay.
Inflation will fall. The Fed will, I think, probably be late to cutting rates as well. The market's saying, late 2023, they'll have to cut rates. That could happen in early 2024. Nobody really knows the timing of these things, right?
Yeah.
To a precise degree. And it's possible the recession couldn't hit until 2024, and it's also possible the recession couldn't hit at all. So given those scenarios, I think the best thing to do is look at and say, what is the market telling you? And right now the market's telling you that recession, more likely than not, late part of 2023, the Fed will cut rates. That will bring the short-term part of the yield curve down. I think the yield curve will steepen, which means that short-term rates will be lower than long-term rates, which is the norm. And that's generally a bullish sign for stocks. That's that usually means that that the tightening era is basically come to a close, and kind of a normality will continue.
So despite
even if we have a recession, it's very likely that the stock market has sniffed it out. It typically does it.
That's what I want to put a pin
11
in.
months prior to the bottom. So it's very likely that the October bottom was the bottom.
Yeah, that's important, I think, for us to draw a line under and make some emphasis around for our listeners. Even if we do have a recession in 2023, it doesn't mean that stocks will move in unison with an economic decline. Stocks tend to anticipate what's coming, and markets tend to anticipate that. It's a question of now, in a recession, though, won't earnings be disrupted on some of the corporate earnings? And why is it that won't be disruptive to the stock price? Or is it simply that's already been anticipated, Brian, and therefore markets can still move forward in the face of an economic decline?
It's tough to tell if it's all been priced in, that's for sure. I don't have the magic answer to that.
Yeah.
But what I can tell you is that stock prices are a function of earnings and interest rates. And if you just if you don't want to take my word for it, Google the terminal value of a equity, and you'll see an equation there. The equation has, basically earnings. It's actually cash flows at the top in the numerator, and it has an interest rate as the denominator. And without breaking your heads with math, I'll tell you that the interest rate is more powerful. The denominator is more powerful than the numerator. So you can actually have earnings decline and stocks rally as interest rates fall. And we've seen a couple instances of this already this year, right? As inflation started to fall in June, we started seeing this inverted yield curve in the longer term. As longer term rates fell, the stock market, in a way, put in a bottom, right? I understand that we put in another October bottom, but the breadth of the market was much better in October. So whether you want to call it June or October, we're off the lows, and part of the reason why we're off the lows is because of the reaction of really the longer term interest rates to expected inflation. So this is a long way of saying that lowering interest rates could buoy falling earnings. Stocks are long-term assets as well. 1 year of earnings doesn't necessarily determine.
Yeah, you made that point before. So it's a combination of these issues, which might seem counterintuitive in the midst of the prospects of a recession, that still could be favorable for stocks over time. Now, again, most people aren't just invested in stocks. If there's expectation of a rate cut, sort of a change in direction, we still have a little bit of increases expected coming in early part of the year in 2023, but then you're saying maybe late 2023, sometime in 2024, we might see a change in direction. Are you referring to the Fed, or are you referring to markets when it comes to interest rates? And how does that work its way into how one should think about positioning into a bond strategy?
Well, the market's already anticipated it. You can see because the 2 years priced at about 4.2%, and the 10 years priced about 3.6%. So that inversion means that the market is expecting the Fed to have to cut interest rates fairly significantly at some point. Now you can just Google it. You can look at Fed fund expectations by the market.
Yeah. And
you can see that they're expected to cut interest rates, the short-term interest rate, in the second half of 2023. So that's not necessarily my opinion. That's what the market is telling you. One of the great things about managing a diversified portfolio, rather than being like a hedge fund or something like that, is we don't have to be all on one side of the boat. We don't have to guess exactly what's going to happen. There's obviously a lot of speculation, whether the Fed's right, whether the market's right. They could both be right. I mean, the reality is that they have different time horizons. The Fed has a time horizon of, the Fed funds rate is effectively a 3-month rate, and the 10-year bond is a 10-year bond. It's a much longer tenor. So the Fed could actually keep rates higher for longer. And you could actually still see the 10-year bond fall. I mean, you'll likely see the 2, the 3, the 4, and the 5-year stay higher. But they're all different rates and different tenors, and I stress that a lot. Now, getting back to why it's a beautiful thing to be in a diversified portfolio is you can barbell your bonds. You can maintain some longer duration bonds that will do better if inflation falls and bonds rally. But you can also keep some shorter duration bonds that won't have as much price fluctuation, that will continue to clip, the higher coupons at the 4.5% to 5% rate the Fed's targeting. And that's a great thing, right? I don't necessarily need to just guess where interest rates are going. I can just lean into where I think the puck is most likely going, rather than making some big one-sided bet and either missing out or losing my share. I can do the same thing with my stocks too, right? If inflation falls dramatically and it's a relatively short recession, you should probably see those, mega cap tech names and the NASDAQ names really rally, where in 2022, they've been the big losers, right? And those value names, which, should be less volatile in general, probably won't recover as much. I mean, they will recover, but not as much in that situation. So you can barbell your stocks too, right? You can have
good points.
More value-oriented names, and you can have more growth-oriented names. That's a great thing about being able to have a diversified portfolio.
Well, no doubt. Sorry, go ahead. We got to wrap it up.
I think the big thing that I'm worried about is everybody is very, very negative, and the sentiment is very, very bad. And what you don't want to be on is you don't want to be overflowing one side of the boat. When the wave comes to take you home, when the recovery,
when the tide turns, so to speak. Yeah.
When the tide turns, you need to be positioned for both, and that has been a big challenge, as an investor this year. But from both your bonds and your stocks, I think that's how you want to be.
That's a great place for us to wrap things up. We're going to be talking about this much more over the weeks and months ahead, so there'll be plenty of opportunity. We have been offering a complimentary portfolio review. If you need a little help in the process of looking at your portfolio, take advantage of our complimentary portfolio review. We can be of help to you in thinking about how you're positioned and whether or not there might be things to do differently. This is a complimentary offer. It is no obligation. It's a 2-meeting process, and we start off by gathering some information from you. If you're interested in checking it out, go to our website, amrfinancial.com, or give our office a call, 508-771-8900. We'll be offering this over the next few weeks. So in any case, Brian, thanks very much. Happy New Year. Hope you have a great, fun plans this evening.
Yep, you too.
All right, and we'll talk to you next year. See you next year. All right, we'll be right back after this. Stay with us.
You're listening to Something More with Chris Boyd.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.